Good morning. We will spend time today on income tax. When we calculate income tax on the profit that the company makes, the income tax is an expense for the business. The SARS account is the liability. SARS has three different types of tax that is paid to them. You pay over SARS income tax, you pay SARS for VAT, and you pay SARS for pay as you earn. So because there are three different accounts, each one of them will indicate with which one you are currently working. So if it is the income tax that you're working with, you will call it SARS income tax. And the account will be SARS income tax. If you pay working with VAT, it will be called SARS VAT or SARS pay as you earn. When checks are issued to pay provisional tax payments, the payments are made to SARS to pay the money that the business makes on the profits to SARS. That means this SARS account must be reduced so that the liability can be reduced. Now remember that SARS is a liability. We have the SARS income tax account that is a liability if you owe money to SARS. If you paid more than the amount that you were supposed to pay as provisional tax payment, the SARS account can be an asset. So SARS is one of those accounts that sometimes it can be an asset and sometimes a liability. But in most of the cases, it will be a liability. Now, if we look at the information provided, the business owed 6,000 Rand to SARS at the beginning of the year. So it means that 6,000 there is outstanding from the previous year. We didn't pay enough provisional tax at the end of the previous year, and that's why we owe SARS the 6,000 Rand. SARS is not going to wait for months to get this money back. So normally at the beginning of the next financial year, you will have a payment so that the business will pay SARS this outstanding amount of 6,000 Rand. Then in the middle of the year, if you want to explain it in a very easy way, the business will make a small income statement, just of all the income and expenses for that 6 months to determine what is the profit. And then they calculate the 28% on that profit and they make a provisional payment to SARS. So that means on the 31st of August, in the middle of the year, a provisional tax payment is made on the profit that they made during the first 6 months, and they sent 60,000 Rand to SARS. That 60,000 Rand reduces the total debt to SARS that the business will have to pay on all the profits that they make. So when the provisional tax payment is made, bank is credited and SARS is debited because this money is paid over to the government department called SARS. You cannot put that 60,000 Rand into the income tax account because you still don't know what the expense for income tax will be. This 60,000 provisional tax is to reduce the liability and the total amount that is owed to SARS. Then an additional entry is done at the end of the year again. A small income statement is made at the end of the financial year on 28 February. And the income and expenses is subtracted to work out more or less what was the profit for the last 6 months. And then a check is issued again for 70,000 on the profit made during the last 6 months. So the bank is credited, and again the SARS income tax account is credited to show that the liability, the total amount that's owed to SARS on the profits of the business, is paid 70,000. The first time that you can write in your income tax account is when you know what is the actual income tax for the year. So at the end of the year, the profit is calculated. as 500,000. This profit of 500,000 is provided after all the adjustments were completed. So all the entries for mistakes that was made, that was corrected, entries that was omitted, that is made at the end of the year, entries that only appear at the end of the year, like depreciation, provision for bad debts adjustment, etc. All those entries must first be completed. And then the books will go to the chartered accountant that will check everything, and they will recommend that certain changes must be made. And as soon as they are satisfied and the auditor says, okay, he is prepared to give you a report that the company's books are okay, then you will work out what is your actual profit. And now for the first time, you know that the profit for the year is 500,000. And then we go and we calculate 28% on that profit amount. So for the first time, you can write in this income tax account and you show 500,000 times 28% will give me the total tax that's payable to SARS as 140. So for the first time, I will write in this expense account to show that we know what is the expense for income tax. Who do we owe the money to? To SARS. So because we owe the money to them, they like a creditor or liability to us, so we will credit their account with the 140,000 rand. At the end of the year, you will have this outstanding amount after the account was balanced. So you will add up the credit side and see the total is 146. Add up the debit side, subtract it from the credit side, and determine that the credit side is 10,000 bigger than the debit side. And that balance will go down on the credit side. So because this balance is brought down on the credit side, it means that this is a current liability. So it's the money that you owe to SARS at the end of the year because you didn't pay enough money during the year as provisional tax. If we alternatively decide that, for instance, the balance is on the debit side, so when we add up, the debit side is bigger than the credit side, and this balance is brought down on the debit side. If the balance is on the debit side, it means that it will be recorded as a current asset. What is the effect of a current asset? It means that we paid too much provisional tax to SARS. We actually made a smaller profit than we thought, so we paid too much provisional tax, and SARS now owes us an amount of money that they have to pay back to us. So what did we learn today? Provisional tax payments are made to SARS during the year to reduce the debt for tax that you will have to pay on the profits that you make. When provisional tax payments are made, you have to debit the SARS income tax account to show that the liability is reduced. You are only allowed to record an entry in the income tax account after the final profit for the year was determined, and income tax is calculated on the profit for the year. So the income tax account will never be used before the end of the year when the final profit was calculated after it was audited by the auditors. You never write in the income tax account during the year. It will only have this one entry at the end of the year. When you pay provisional tax payments, you will debit your SARS account to show that you reduce your debts.